Section 1:1 Introduction to Beta, 1.1 Definition and Concept of Beta. Beta is a measure of systematic risk, which refers to the sensitivity of an asset's returns to the overall market movements. It quantifies the relationship between the returns of a particular asset and the returns of the overall market or a benchmark index. The beta coefficient is calculated using statistical methods such as regression analysis. It compares the historical returns of an asset, typically represented by a stock or a portfolio, to the historical returns of a market index, usually the broader market represented by an index like the S&P 500. The beta coefficient is expressed as a numerical value. If an asset has a beta of 1, it tends to move in sync with the market. A beta greater than 1 indicates that the asset is more volatile or has higher systematic risk compared to the market. On the other hand, a beta less than 1 suggests that the asset is less volatile or has lower systematic risk than the market. Here are a few key points to understand about beta as a measure of systematic risk. Market benchmark. Beta measures the systematic risk of an asset relative to a market benchmark. The benchmark can be a broad market index or a specific index that closely represents the asset's market sector. Systematic risk. Beta captures the systematic risk, which is the risk inherent to the entire market or a specific segment of the market. It measures how much an asset's price tends to move in response to changes in the market as a whole. Unsystematic risk. Beta does not account for unsystematic risk, which is the risk specific to an individual asset. Unsystematic risk can be mitigated through diversification. Beta only focuses on the portion of risk that is influenced by the market. Interpretation. A beta greater than 1 implies that the asset is more volatile than the market, and its returns tend to fluctuate to a greater extent. A beta less than 1 suggests that the asset is less volatile than the market. Beta of 1. An asset with a beta of 1 is considered to have the same level of systematic risk as the market. If the market goes up by 10%, the asset with a beta of 1 would be expected to increase by approximately 10%. Beta below 0. A negative beta indicates an inverse relationship between the asset's returns and the market returns. When the market goes up, the asset's returns tend to go down, and vice versa. Negative betas are relatively rare and often associated with assets like gold or certain hedge strategies. It's important to note that beta is based on historical data and may not fully capture the future risk of an asset. It's just one tool among many used by investors to assess an asset's risk profile. Investors should consider other factors, such as company-specific information and market conditions, when making investment decisions. Beta measures the relationship between an asset's returns and the overall market movements. It provides insights into how the asset is expected to perform relative to the market as a whole. Let's explore the relationship between beta and market movements in more detail. Positive beta. A positive beta greater than 0 indicates that the asset tends to move in the same direction as the market. If the market goes up, the asset's returns are expected to increase, and if the market goes down, the asset's returns are expected to decrease. The magnitude of the beta determines the extent of the asset's sensitivity to market movements. A beta greater than 1 implies that the asset is more volatile than the market, amplifying its movements in both directions. Beta of 1. An asset with a beta of 1 is expected to have returns that closely mirror the market returns. If the market goes up by a certain percentage, the asset with a beta of 1 would be expected to increase by a similar percentage. Similarly, if the market goes down, the asset's returns would be expected to decline proportionally. Negative beta. A negative beta indicates an inverse relationship between the asset's returns and the market movements. If the market goes up, the asset's returns are expected to decrease, and if the market goes down, the asset's returns are expected to increase. Assets with negative betas are considered defensive or countercyclical, meaning they tend to perform well during market downturns. Gold and certain hedge strategies are examples of assets that often exhibit negative betas. 0 beta. A beta of 0 suggests that the asset's returns are not correlated with the market movements. It means that the asset's performance is independent of the overall market performance. However, it's important to note that a zero beta does not necessarily imply that the asset is risk-free or has no volatility. It simply means that the asset's returns are unrelated to the market's returns. It's crucial to remember that beta is based on historical data and does not guarantee future performance. Other factors, such as company-specific events, industry trends, and macroeconomic factors, can influence an asset's returns and deviate from its historical beta. Therefore, beta should be used as one of many tools for assessing an asset's risk and should be interpreted alongside other relevant information. Additionally, it's worth noting that beta assumes a linear relationship between the asset and market returns. In reality, market dynamics can be complex, and the relationship between an asset and the market may not always follow a linear pattern.